Thank you. And this paper is, I would characterize it as an amalgamation of a lot of work that we do at Towers Watson just in the course of business. Every year, sometimes even several times during the year, we collect data on various aspects of how corporate defined benefit plans are doing, what they're doing, government policy that's related to them. And so in this paper, what I've done is I've collected that information, that data, that analysis, and identified the impact of the global financial crisis. So I think what you will see is an extensive discussion of point by point as to the impact of the global financial crisis on defined benefit plans, particularly from the point of view of the plan sponsor, and to a secondary degree from the point of view of the federal government. So first we'll start just by setting up some background, which has already been stated, but just focusing it particularly as it affects corporate pension plans, what the external environment was over this period. Then a summary measure of how it affects plans, which is the funding status. Then we'll look at investments, how those have changed over these years, employer contributions, actual sponsorship and design of plans, which we follow very carefully. Then in the paper, there's a lot of detail about the development of temporary funding relief from the government for pension plans. In this presentation, I'll just be very brief about it, but in the paper itself, there's a lot of detail, and it's, I think, of interest in terms of it covers the details of how funding relief was granted in its various permutations. Then I'll review what has happened to the PBGC in terms of its financial status, and then I'll briefly discuss some reform proposals that have been put forward in response to the financial crisis. Again, in the paper, a lot more detail about that. Here, I'll just give you a couple of highlights, and I'll conclude thereafter, and look forward to your questions. This is very familiar. We all start with looking at what happened to the stock market. I do this on a monthly basis simply because I think, particularly as you follow the legislative changes which occurred, they were following things on a monthly basis as in terms of what was going on, and then I accumulate them to annual returns. So in 2007, we had a small positive return for the year. In the stock market, of course, stocks are a large investment of pension plans, say for the purposes of discussion right now, say 50 to 60% of the portfolio. 2008, of course, we had a phenomenal decline, almost 40%, and some reversal of that in 2009 and 2010. As important to the funding status of the plan is the way upon which the liability is discounted. This is a rough number to use, but I think it's not a bad number. It's published by the IRS. It's the composite corporate bond rate. And in fact, what plans use is a yield curve of different aspects. There are different choices that a plan sponsor can make in terms of what flavor of the yield curve to use. But I think as just getting a sense of what happened to interest rates as they relate to the valuation of the plan, the corporate bond rate as published by the IRS is a very good summary measure. And what you see is, unlike Treasury rates, which were declining very rapidly over the period, corporate rates actually were increasing into the recession and into the depths of the global financial crisis, so that in October and November, rates were almost 8%. They jumped up a little bit again in March of 2009, and then they have declined pretty much pari passu with Treasury rates. But this is very important in terms of the measurement for funding purposes of defined benefit plans, and even month by month. So again, we'll cover that a little bit later, but it's important to know the background here in terms of how rates look month by month. So this is the funding status of plans for the Fortune 1000 companies. I looked back a little further than the global financial crisis just to give you a context of past recessions, of past market ups and downs. There are two lines. One is the in aggregate, so as if all the plans were one, and then looking at it as an average over the companies. This is accounting data, so we're not yet at the regulatory information, but this is what's reported by companies at year end. And as you see in the first recession in this time series, you had a very substantial decline in the funding status. Let's say looking at the aggregate status from 124% to 82%, and in the most recent recession and global financial crisis from 106% to 77%. So 77% represents a low number, clearly, perhaps not as large a percentage point decline. And then since then, through 2009 and into 2010, estimated, there's been modest improvement. And the improvement comes obviously from the improvement in asset values, but it's tempered by the decline in the discount rate, which increases the liability. And as we will see, there have been a pretty large corporate contributions to plans. So when you add all that up, that amounts to I would characterize it as an improvement, but still there's a long way to go in terms of the funding status of plans. If you look at the distribution across companies of funding status, things look a little bit better in the following illustrations. So let's focus on plans that are very well funded, from over 100% funded. So at the year end 2008, well into the financial crisis, only 4% of companies had plans that were 100% or better funded. By 2010, we're back up to 10%. And then looking at the obverse, the very poorly funded plans of companies, in 2008, over 7% of companies had plans that were funded at less than 50%, and this has declined to 1.6. So the averages do cover up a little bit of what is happening in the distribution, and I think the distribution looks a little better than the averages. But clearly, 2008 was a very bad year. So what were the reactions of plan sponsors to the financial crisis? And again, putting it in the context of historically what has occurred. One thing which we have seen, I think, pretty dramatically and pretty definitively is a movement away from equity investments. So this is flow of funds data. It's a little not perfect because it includes multi-employer plans, but largely it's single employer plans, and also I show by contrast what has been happening in DC plans overall. So this shows, so the line labeled DB equity is the share of equity in the portfolio of defined benefit plans, and through 2006, defined benefit plans were increasing their exposure to equities until it was about 70%. But after 2007, already in 2007, even before the financial crisis hit, certainly in 2008, and furthermore in 2009, you have a very substantial change, and so that the share of equities in the portfolio has declined from 70% to about 50%. And I will say that this is a conscious choice, because you might say, well, it's just in 2008, that represents just the decline in asset values, but then you wouldn't see that in 2009. And furthermore, if you see the comparison to DC plans, where a lot of investors are more passive and just their shares just go up and down with the market, it goes in the directions that you would think. So, for example, in 2008, DC plan participant exposure to equities declined with the market, but then it came back up with the market. Whereas in DB plans, clearly we have a conscious choice of plan sponsors to de-risk their plans. I would say that this is something which actually the consulting community has been advocating for many years, and it's interesting to see that that message has finally hit. This is another way of looking at the same data. Actually, this is not flow of funds data. This is corporate reporting and looking at it by distribution of plans. So overall, from 2006 to 2009, in this data sort, you see the same change in aggregate allocation to equities. But looking at it as a distribution, again, you see, whereas in the past you would have had many plans, above 70% allocations. Looking at it more recently in 2009, you see the obverse, that many plans have actually cut back severely their allocation to equity, so that many are even below 40% allocated. That's one reaction to the financial crisis. The other reaction is employer contributions. So this is, again, for the Fortune 1000 companies, again, looking at it in a historical context. It goes up and down with the funding of plans. And in 2009, these companies contributed $60 billion to the plan. And what's interesting is that this is largely not reflective of a legal requirement. And that's what I'm going to focus on next. So these are, we'll call them excess contributions, voluntary contributions. The law and the various regulatory changes which occurred during the financial crisis allowed companies to make much less of a contribution, but companies nevertheless have increased their contribution flow to the plans. This next chart shows what has been happening to plan sponsorship and plan design. We're all familiar, certainly in this room, of a movement away from traditional defined benefit plans. What I think is interesting here, this is for the Fortune 100 companies, what's interesting here is that there's not been the same movement away from hybrid plans. That has shown much more stability. But certainly there is a movement away from defined benefit plans. And in surveys that we've done in the past, even before the financial crisis, probably one of the biggest considerations for companies sponsoring the plans is the volatility of the cost of the plan. And we see that in the movement away from traditional plans. Now, as I indicated before, there's a lot behind this, these calculations. We calculated both on a sort of historical basis, but also on a projection basis, what the various, again, regulatory, legislative relief that was provided, and what the impact of that is on required contributions. So let's, for example, just focus. This is for the entire universe. These are estimates. They're not necessarily based entirely on current data, but we've estimated it and projected it as best we can. Let's focus, for example, on pre-relief without funding relief. The actual contribution in 2009 was $92 billion, but the required contribution, because of all the relief that was provided, was actually only $25 billion. So a lot more is being contributed than what is required. But going forward, we see the need for very substantial additional contributions in 2010, particularly 2011, when again, I'm not going to go through the details, various mechanisms of smoothing and calculations of discount rates used in calculating the liability will move towards the market conditions, and particularly given the projections that we have of what interest rates will be in the future years, very substantial contributions will be required. The relief, the most recent relief, which was passed last year, which was actually a contingent relief, certain elections had to be made, according to our calculations, was very, very minimal. So if you compare what would be required, for example, in 2010 or 2011, with the relief and without the relief in the actual elections, it has not had much of an impact. The PBGC. So here, these are data coming from the annual reports. Like the funding status of the pension plans themselves, the PBGC is also moved up and down with asset returns and with interest rates. Again, in the most recent recession, in 2008, and this is the fiscal year, so it's September 30th. Its deficit was only $10 billion, and it increased to $21.5 billion for the single employer program in 2010. These are some numbers, just I don't think I have time to go over them, that sort of show where those changes occurred. Interestingly, certainly there were some plans that terminated on an underfunded basis, but the majority of the change comes from the actuarial charges and adjustments, and that is primarily the discount rate changes. And here I just want to show the next chart just to show that there actually is a pretty significant difference between the way the PBGC does its discount rates and the way corporations calculate their liabilities using the IRS CCBR. And again, the paper will describe some of the changes that the PBGC has made over the years, but there is recently, between 2006 and 2010, a fairly not a great correlation of market rates to the PBGC. Particularly in the most recent, at the end of the time series, the two data actually go in different directions. Some have proposed basically scrapping pension plans entirely, whether DC and DB, and proposing new third-party institutions. Others have said that we do maintain the role of the employer. The Obama administration has proposed raising the PBGC premiums. And in the paper, I sort of highlight a few other reform ideas to reform the excess funding excise tax for defined benefit plans and create new types of plans that basically split the difference in terms of where risk is borne between the employer and the employees. So let me conclude by saying clearly funding has declined in response to the global financial crisis. Employers, plan sponsors reduced the risk of their investment portfolios in response. They also increased contributions considerably beyond the minimum. There continue to be plan changes, particularly away from traditional formulas. There was temporary and sometimes conditional funding relief given. Reform discussions continue. And I would say that we still are grappling with the issue of what is the appropriate location of risk-bearing and the structured nature of benefits. Thank you.